Welcome to Retirement with Jim. So today, annuities. Yes, no, what's your thoughts? So before we get started, if you like my channel, please consider hitting the like button and subscribing to my channel. Helps my channel grow. With that, let's get started. So we got the pros and the cons of annuities in retirement. So forgive me as I look down. I got a lot of notes. Um, So, kind of like what your thoughts are, whether you like annuities, don't like annuities, and there's a lot of myths around annuities that aren't necessarily true. So, pros. The pros are, guaranteed incomes. It provides a reliable stream of payments for a set period or for life. It's tax deferred growth until you withdraw. Then your taxes are paid at that point. The principal has protection. It's whether it's a fixed and the index options protect against market loss. So you've got a wide range of riders that you can choose from to help protect your basic principal. Excuse me. Customization. Um, Riders allow for additional features like death benefits or inflation protection. So there's a lot of things that you can do with a variety of riders you can put on. And there's probably one of the biggest features, no contribution limits. Unlike a 401k or an IRAs, you can contribute as much as you want. There's no limit. So, cons. Well, there can be and are, depending on what you choose, a lot of high fees and commissions. The expenses that are associated with that, include administrative fees, and agent commissions can be high. So you really have to do your due diligence and do your research to know what you're getting into. Limited liquidity. Funds are locked in for long periods, and early withdrawals can incur significant surrender charges. So you want to know for sure, what kind of access do you want or think you need to your money before it matures. Excuse me. Um, So complexity. Now complexity, there is a variety of types. You're fixed, you're variable, you're indexed, and writers can make them difficult to understand. So there's a lot of complexities, and it really requires that you get some help. So, and inflation risk. You got to be careful because with some fixed payments, they may not keep up with the pace of inflation over time. So, because there's so many choices out there, you could see some of your, principal erode over time. So it's something to look at. And the insurer risk. So the guarantees are only as strong as the insurance company's ability to pay out. Now, you can also get annuities from your bank. Now, your banks have a tendency to always want to show you the top 5. And you could be missing out on a lot of opportunities because there are so many out there. But yes, if you're highly likely your bank would go under, but it's always a possibility. But the insurance company, yeah, if it's small enough and they aren't as strong, and there's things that you don't know about them. If they don't have that ability to pay and they go under, you lose everything. Your principal, everything is gone. So it's just something to think about. Now, the best advice I would give anyone is get help from a fee-only advisor. There's plenty of financial advisors out there, and many will work, taking a percentage. But if you're just wanting, some help in getting started and understanding then find someone who will help you on a fee-only basis. This is what they will do for you, and this is what their pay structure is, and you kind of know that up front. So no hidden costs for yourself. So fee only is a really good way to go. And there's all types of annuities. So you've got your MIGA, as they call it, which stands for multi-year guaranteed annuities. They go out through periods of 3, 5, 7, and 10-year annuities. You've got your fixed index. So you've got, fixed index as well as just fixed, and the variables. The variables, which a lot of, when you're younger, people might want to get into variables because they want to tie it to the market. They are the ones with the most fees. They are the ones that are the most volatile, but they are the ones that stand to make the most money. So if you're young enough and you're getting in, you want to be able to maybe grow your money over time. Variables, are probably a way to go. And you have, payout options. You have immediate versus deferred. Some of them, the immediate, they can start a payout shortly after you purchase them. So, and the deferred, your value, of course, grows over time. So it's just, there's a lot in there. The one maybe downside is you need a lump sum amount of money to purchase, your annuity. Most average annuity they're looking for about $100,000. Now you can get them for less, but then it's based on $100,000, for instance, is going to pay you $500 to $1,000, sometimes a little more, depending on the length of time and everything in there. But on average, it's going to pay between $500 and $1,000 per month once you start drawing that money. So remember that it also depends on your age, your gender, and your chosen payout option: lifetime over fixed. Single versus joint. Your age makes a big difference when you're going to start paying that out. Are you going to pay it out at 65 or start at 70 or start at 80? You want that. And most people take the annuities because they want to cover any shortfalls that they think they may have in their financial and their retirement plan. They start to run short on money. Planning to have an annuity guarantees you've got that money coming in at a time in your life when, depending on how your retirement savings have lasted, would be a good boost to you. So it's something to think about. And certainly, when I say gender, it pays a lower amount to women because usually they live longer, so it's structured that way so that the money will last, because of they live longer. And also whether you're taking a lifetime over fixed. Your fixed might be a 3 or 5 or a 7 or 10-year program. Lifetime, then the pay structure is going to be different because that money is paid out over time. And of course, you then want to look at whether you have a death benefit on there. Are you turning that over, the balance over to the insurance company if you don't have a rider specifically to do that? And it's funny that you would think that wouldn't happen, but people don't always choose the right riders and the right information, and that's why you really need someone who's got the expertise, because you don't want to make that mistake. You want that, if you die, you want that benefit and the rest of your money turned over to a spouse or another family member, whatever it may be. The biggest disadvantage, as I see it, is limited liquidity, limited access to your money if you really need it. It's probably the largest downfall. But There's many big insurance companies, many big banks that offer these, and they're a great savings tool, and they work out, wonderful at a time in your life when you want that money to come in. Maybe you're hitting 70 and you want that extra thousand or more a month, for whatever length of time you've got there. Um, and the best age to buy, well, there really is no best age. But on average, most people typically purchase them in their late 50s. And that is because they are planning to then take them sometime in their 70s. So in their late 50s, they're 10 to 15 years out before they start to choose for them to pay out. So, like I said, there's no perfect age, because if you're younger, you may choose to, get involved in it at an early age and try and grow it. The biggest drawback, like I said from the beginning, is you don't usually have a lump sum to put down. But there are some of them have installments where you can either put down a lump sum or you can pay over time, to make that grow. So, but once again, get some help. Get someone who's really knowledgeable, who's educated on that, because it can be a great tool to help you in your retirement. So with that, let me know. Let me know what you're thinking. Do you like it? Do you don't like it? You agree with it? I'd love to hear from you. So with that, I'm going to tell you, have a great day, and I will see you in the next one.